The British bond market is in full-blown meltdown mode. The 30-year gilt yield just spiked to a 27-year high. The pound is plunging over 1% against the dollar in a single day, and whispers of a fiscal doom loop are echoing through the halls of Westminster. But is this just market jitters or the beginning of a full-blown debt crisis that could cripple the UK economy and spread across the globe? So, the 30-year gilt yield, remember the value of the bond is inverse to the yield. So, as the bond gets dumped and sold, the yield goes up. We can see the yield is making a sharp move higher over the past 24 hours. There's a slight bid coming in over the past hour or so. But remember, the way that this is supposed to work is that higher yields attract foreign capital. And so the way that that mechanically works is foreign investors sell their native currency to buy pounds. Remember, gilts or government bonds in the UK are pound denominated, so you need pounds to buy them. So the way it should work is, say, a Japanese investor sells the yen to buy the pound, putting upward pressure on the pound, and then they buy the UK 30-year gilt yield. And we are seeing that to some degree. There's a bit of a dead cat bounce in the pound, which was down over 1% versus the dollar. But that is not what we have seen over the past 12 hours. What we have seen over the past 12 hours is the pound is down sharply, 1% against the dollar, despite higher rates. So what this means, what this indicates, is that people do not want to be in the UK, the long end of government bonds in the UK. For example, here, the 30-year. So what that means is they are selling the bond, pushing the yield higher, as we can see here, sharp move higher. They're pushing the yield higher, selling the bond, but then they are selling the pound. So this is what happens during capital flight. And by the way, there's been talk of an IMF bailout. So this is quite serious, what's going on in the UK. They're selling the pound. So not only are foreign investors not coming and buying the pound to then buy the 30-year, that is happening to a minor degree. But not only that, but the domestic investors are selling the gilts, selling their government bonds, and then selling the pound. This is what you see during capital flight out of a country, generally in an emerging market, by the way. So what are they flowing into? Well, the dollar, for one, and gold for another. So here is the gold in pound terms, and we can see this taking a sharp leg higher in pound terms, which again, the pound has been weakening. Here, if we look at the FTSE 100, this is their version of the S&P 500, their major stock index, collection of their largest companies. It is down quite notably over the past week or so. Here's the yield curve. So again, the lighter colors are shorter duration. As you get darker, it is going further out in duration to the 30-year. What we can see is that, again, going back to the summer of last year, when central banks around the world started to cut interest rates, what we see is outside of the very short end of the yield curve, like the 1 year or the 3 month, outside of those very short duration bonds, bond yields have gone up. Now, remember, the value of the bond is inverse to the yield. So when you have yields going up, the value of the bond is going down. This is why it's what's known as a bear steepener. So much like the US, they are seeing a bear steepener, again, if you exclude the 1 year and the 3 month and the very, very short end of the yield curve. And what that means is that the spread, the premium that is being demanded to buy longer duration debt, like the 30-year, for example, here, that premium is growing wider and wider and wider over a short duration bond. And so here, this pink line shows the difference between the 30-year yield and the 2-year yield. As this pink line moves up, what that is indicating is the gap between the purple line and the yellow line is growing wider. So why does this happen? Well, it happens for one of two reasons. In a bull steepener, it happens because investors are flocking to short-term bonds expecting rate cuts. That is what's known as a bull steepener. They are buying bonds, pushing yields down, just pushing the short-end yields down the most. That is a bull steepener. Well, here we are seeing the exact opposite, which is what's known as a bear steepener. Again, if you exclude the 3-month bill and the 1 month, or excuse me, the 1 year, the very short end of the curve. If you look at the 2-year, 5-year, 10-year, 15-year, 20-year, 30-year, 50-year, you are getting what's known as a bear steepener, which is the value of the bond is actually going down. So it's the exact opposite of a bull steepener, which is normally what you see during a rate cutting cycle or ahead of a rate cutting cycle. So investors are demanding higher and higher and higher premium to buy long-term government bonds. This is generally a sign of fiscal acute fiscal stress when you see a bear steepener like that. So, what is going on with the UK economy? They run what's known as a twin deficit, much like the US. Here we can see the fiscal budget as a share of GDP, and we'll explain why that's important in a second. The fiscal budget deficit, which is the difference between what the government spends and what it collects in revenue, uh, that difference expressed as a share of GDP. And we can see it's about 5%. Now, the US runs a 7% fiscal deficit, which is just utterly insane. But the US kind of gets away with it being the reserve currency issuer of the world. Now, if we look at the other major account, which is what's known as the current account. This is mainly the balance of trade. We can see that the UK, very similar to the US, runs a twin deficit, meaning the current account is, again, mainly the balance of trade. And what this is indicating is that Great Britain imports more goods, sends more money abroad than they raise from exports, right? They are spending more money on imports than they are raising from exports. So money on a net basis is flowing out of the British economy. Now, you add that in with the fiscal deficit of 5% of GDP, which is quite large, especially for a country that is not the reserve currency issuer, and you are in pretty serious trouble. This is what's known as a twin deficit. And again, the US runs one. The current account deficit in the US is actually worse, about 4%. And the fiscal deficit for the US is about 7%. But again, they kind of get away with it because the US is the reserve currency issuer of the world. Well, the UK is not so lucky, is not able to get away with it to the same degree. And we are seeing the consequences of these massive twin deficits in the UK with a weaker currency and higher bond yields, or put another way, investors are selling long-term government bonds and they're buying gold and they're buying the dollar. So capital's fleeing out of the pound and out of pound denominated assets like government bonds, which are called gilts in the UK. So here we're looking at GDP annualized out. It's about 2.9 trillion pounds of GDP. And then we're looking at government spending on an annual basis, government revenue on an annual basis, and government tax revenue on an annual basis. So the US does not do this where they split it up. But here I thought I would include it because the data is offered that way. But what we can see is that, again, this spending number is a monthly number. So there can be kind of extrapolations when you multiply it out to get an annual number. Depending on the month, some month the spending is higher, so you'll get a higher reading. But as of the data that as of the last data and extrapolating that most recent data out, government spending is running at about 57% of GDP. So if you thought the US was crazy with 25% of GDP, the government spending as a share of GDP in the UK is 57%. Put another way, out of all the economic output of Great Britain, 57% of it is projected to just be government spending. Now, why it matters, remember, the other way you can think of the fiscal budget, 5% of GDP, is that every year the debt must increase by that amount. Because remember, the way the government covers a fiscal deficit of 5% of GDP is by issuing that much debt, right? So if the deficit is, say, 1 trillion pounds, what that means is the UK government must issue 1 trillion pounds per year to finance that gap between revenues and spending. Well, looking at it as a share of GDP is important because GDP is the balance sheet capacity to absorb all that new debt. So the doom loop that people are worried about is that, remember, the government must issue new debt, 5% of GDP per year, to cover the gap in spending and revenue. Okay, well, remember that bonds act in the law of supply and demand just like anything else. So if you are increasing the supply and demand stays constant, the value of the bond must go down. Well, that pushes the yield higher. Well, what does a higher yield mean? That means higher interest expense as the debt needs to be refinanced or issued to cover, say, next year's fiscal deficit. It is being issued at higher interest rates. Well, how do they pay the interest on the bonds? By issuing even more bonds. So again, you're pushing now because interest expense is going higher due to higher rates. Now your deficit is getting even worse because you have to pay the bondholders the interest. So you have to issue even more debt. So your 5% fiscal deficit goes to 6%. And what that means, again, is that you are increasing the bond supply. Again, assuming constant demand, that pushes the value of the bond down, the yield up even more, blowing out your interest expense even more, therefore pushing your deficit even lower. So hopefully you can, that is intuitive how that can become a self reinforcing doom loop or debt doom loop, as some people call it. So here's the annual government expenditure running at about 1.3 trillion. And what I wanted to point out was GDP that is coming from public administration. And what you can see with this is, again, in case the 57% of GDP going to government spending, in case that wasn't clear enough, the UK is really bloated when it comes to their bureaucracy and their public administration. And we can see that here from the annual GDP from public administration right now, running about 181 billion pounds per year. But look at the sharp leg higher that it took from, say, 2022, 2023 up till now. So this appears to be one of the main issues that is driving the deficit. So here's GDP per capita, and we always make the point that debt crises aren't really necessarily about the debt, but much more about growth than a lot of people realize. So we're going to look at growth. Here's GDP per capita, and we can see that going back to 2007, I will measure this out. Going back to 2007, GDP per capita has grown a whopping 6%. Now, down here in red is the annual rate of change of GDP per capita. And again, you can see that it used to be back in the 60s and 70s, much like the US, we had higher growth in the West. Back in the 60s and 70s, this was running at 3.5%, 4%. Well, what is it running at now? It is basically running at zero, meaning on a per capita basis, their economy is not expanding. So here we're going to zoom out and look at just real GDP. So this does not account for increases in population. Here we're just looking at aggregate real GDP being inflation adjusted gross domestic product. And the white line is showing you the annual rate of change of that GDP. And again, notice the downtrend in terms of growth. This is one of the issues that the US also faces. Well, real inflation adjusted growth is only running at 1.2%. Again, not even adjusting on a per person basis for change in the population. If we look at inflation, it is running at 3.6%. This is pretty textbook stagflation. You have in the recent couple quarters, you have inflation heading higher, closer to 4% than it is to 3%, and you have real GDP or real inflation adjusted growth turning down, curling over. So you have inflation going up and real growth heading down. That is kind of the textbook definition of stagflation. Now, if we look at nominal growth, that is running at about 4.8% on a year-over-year basis. Again, this is just adding inflation to real GDP. Now, again, this is why it matters. So here we're looking at the cost of the debt. Now, the average debt instrument in the UK is 14 years in duration. So here, luckily, they have a 15-year gilt, so we can look at that yield relative to nominal GDP. Remember, if you can keep the cost of your debt, as measured here by the 15-year interest rate, if you can keep that cost below your nominal growth rate, the debt is not really too much of an issue. However, if the cost of your debt starts to rise above your nominal growth rate, things get bad pretty quickly. And you can see, by the way, that that generally happens during a recession, as you can see here in '08 and 2020. Now, in white, what we're looking at is what's called the real yield, or the inflation adjusted premium over inflation, the yield over and above inflation that the government must pay to bondholders. And what we can see right now, they have positive real yields of about 1.5%. Now, the average debt maturity is about 15 years. I think it is 14 years. But what we are seeing here is real yields are being restrictive. So again, as real yields fell and the interest rate on the debt was falling for many decades, the West was able to generally get out of a lot of debt issues because the cost of the debt was falling. Well, as we saw in 2022, that trend, that long life cycle trend, that 70-year trend of falling interest rates is over. You can see the breakout here in terms of the real yield. It broke out in, say, 23, 24. And the real premium over and above inflation that the government must pay to bondholders is starting to rise. Now, it had a bit of a pullback in the past couple months or so, but the fact that it's still 1.5% above the inflation rate means positive real rates. This is restrictive on the government's finances. So here we're looking at the 10-year gilt yield. And I wanted to point something out. I'm not an expert on the UK, so if there are any British fans, watching this video and I get something wrong, I apologize. Did my best to research and get familiar. But the reason that I wanted to point this out here, we're looking at interest expense on the debt, because again, remember the doom loop is that as the deficit means you must issue 5.5% of GDP every single year. That's higher bond supply. Well, higher bond supply pushes the value of the bond down and the yield up. Well, as that happens, the debt must be rolled and refinanced and issued at higher interest rates. How do they pay the interest? By issuing even more debt. And so hopefully you can see how that is a doom loop. We need to look at the interest. So here's a number of ways of doing that. Interest expense in annual terms, about 85 billion pounds. Interest as a share of tax revenue, about 13%. And then interest as a share of government revenue. Again, they break it down two different ways. We can see that that is about 10%. Now, if you look in the US, interest as a share of overall government revenue is actually about 20%. Now, again, the US gets away with a lot because of being the reserve currency issuer of the world. But here we can see a steep drop in the interest expense, both in nominal terms and in share of kind of government revenue terms as well. So I looked into what caused that, and this is what I was able to find. So they have basically a version of what's known in the US as a TIPS, or Treasury Inflation Protected Security. It is a type of government debt instrument that pays over the interest rate. So it's a way to protect against inflation. Well, their inflation rate dropped from 14% in 2022 to approximately 5% in 2023, and that reduced the interest payments on those particular kind of special gilts because, again, the inflation rate was falling, so therefore the amount that the government had to pay dropped pretty significantly. And unlike the U.S., about 25% of the UK government debt are issued in these inflation linked sort of gilt instruments, these debt instruments, which are, again, tied directly to the inflation rate. So as inflation falls, the interest expense falls because 25% of their debt is in these inflation protected securities. But again, if we go back to the inflation rate here, we can see that this has been curling up and going in the wrong direction. So it's good for nominal growth, but again, it's very stagflationary. And what we can see is that the inflation rate bottomed here at 1.7% in September of last year, around the time that rate cuts started, and has been heading ever higher since. Now, again, very close to 4%. So the fact that 25% of government debt over in the UK is in these inflation protected securities, as that inflation rate falls, that is helpful. However, if this starts to head higher, as we are seeing recently, that could be very, very difficult for the UK government to finance. Of course, there was also the Asset Purchase Facility, or APF, and that helped to offset interest expense by holding gilts financed at basically zero interest rates back, in the ZIRP era. And that effectively reduced the net interest expense to the public sector. So there were some interventions going back. Remember the gilt crisis and the Liz Truss moment and the mini budget and all of that. There were some responses to that helped to get interest expense somewhat under control. But again, remember, they are not able to avoid financial gravity forever, just like the US. So why does this matter? Well, if we look at the tick data, the UK, again, is a twin deficit nation, unlike, say, Japan, which we can see here. They run a very large current account surplus. The UK runs a twin deficit. So Japan, again, they are accumulating national savings as they run a trade surplus or a current account surplus. More value is coming in than is leaving the country to spend on exports. So they need something to save. They need a way to save. Well, the way that they've historically done that is by buying U.S. assets like U.S. treasuries. Here we see, as of the most recent data, they hold $1.1 trillion in treasury debt. The UK, being our second largest debt holder, holds $858 billion of treasury debt. And again, they run a current account deficit and a fiscal deficit. So what this means is they make very, very bad debt holders or creditors to the US. Because again, as soon as they get into crisis, which it appears seems to be striking right now, what are they going to sell? As Luke Roman always says, you sell what you can, not what you want to. Well, they have $850 billion of US Treasuries that they can start selling to finance their current account deficit and their fiscal deficit. So this is how markets become interlinked and how contagion can start. So I did want to address very briefly kind of central bank dynamics. Debt to GDP is actually lower than the US. Again, the US gets away with a lot being the reserve currency issuer, running at about 95%. M2 relative to GDP, put another way, M2 divided by GDP, they have a similar trend to the US, which is M2, or the broad money supply, has been expanding faster than GDP. And that is why debt divided by GDP, the white line, is also going up. Debt and M2, or the money supply, are expanding and getting ever less actual economic output in the form of GDP. If we look at foreign exchange reserves, it's about $185 billion according to TradingView. The central bank balance sheet as a share of GDP is about 29%. Now, it was much higher, again, back in 21, 22, reaching a peak of, it looks like, about 46%. So this is much more elevated than the US. Their debt to GDP is lower, but they're experiencing similar dynamics, which is they are trying to print their way to prosperity by issuing more and more debt, printing more and more money, and getting ever less GDP. Who is buying the debt? Well, the central bank balance sheet is about 29% of GDP currently. In the US, by the way, for perspective, it's about 23%. So here we're looking kind of cross asset, and gold is just absolutely ripping. It was showing a lot of strength yesterday, but it is just parabolic, going vertical today. So what else do we see? We see volatility is up sharply. By the way, the members in the member recap, we called for a pop in the VIX here. So if you caught that, maybe you were able to capitalize on this pop in the VIX. But the S&P is down significantly. Mag 7 is down almost 2%. The NASDAQ is down 1.4%. S&P 500 down 1.3%. Bond yields across the curve in the US, 2, 10, and 30, they were up sharply. The 30-year briefly touched 5% here in the US before a bit of a bid came in and the yield started to come down. Again, remember, the capital fleeing Great Britain must go into something. Well, we can see to some degree that is the dollar. Now, the dollar is only up 0.5% currently, so it's not seeing nearly as much of a bid as it used to see, say, 5-10 years ago in a kind of sovereign debt scare or a fiscal crisis in a developed market. You would normally expect to see the dollar up more than that, especially with higher rates. The fact that it's only up 0.4, 0.5%, I think is telling. And meanwhile, you have gold that is up 2%. Now, Bitcoin is up almost 2% as well, which I think is interesting. It is not trading as levered NASDAQ, which again, NASDAQ is down 1.5%. So Bitcoin is maybe starting to break that divergence in the hint of a crisis. And again, I want to look and show this is not just in the UK. We covered France a couple days ago. We've been covering the US, obviously. So here are a couple rates that are notable. So Great Britain is in this dark red. Again, we can see that has hit a high going back many decades. The same is true for Japan. Their 30-year JGB yield, again, the long end of the yield curve is really what's being impacted here because that is the most convex part of the yield curve. That is where inflation eats away at the most of the bond value. It is the most pronounced at the long end of the yield curve. This is why it's important. This is where fiscal concerns and kind of debt dynamic concerns, this is where they get expressed. They get expressed at the long end of the yield curve. And by the way, you see things like gold ripping 2% higher. That is pretty textbook. You know, the debt around the world is becoming an issue in an acute sort of way. So we covered France. Their bond yields are heading sharply higher, continuing that move sharply higher, looking like they're about to go parabolic. And in Great Britain, again, we covered that in this video. The JGB 30-year JGB yield, this is at a new all-time high. I will zoom out, and you can see that the 30-year JGB has been issued since 2006, and it is an all-time high for Japan. Now, Japan is not seeing that sharp weakness in their currency, so probably less concerns over imminent acute stress in Japan. Where you seem to be seeing it really is in Great Britain, which is this dark red. Again, this is the highest rate going all the way back to 1997, 98. If you look at yellow, which is France, this is the highest yield going back 16 years to about 2007, 2008. So bond yields across the curve, again, bond yields at the long end of the yield curve across the world are headed sharply higher. And this is why higher yields matter, is because higher yields one place mean higher yields everywhere, especially when you mix it with tariffs and capital wars, because again, trade wars are capital wars. The US has accumulated a massive net international investment position, negative 95% of GDP, which is, at least from what I found, a world record in the history of economies in all around the world. That is a record. So what that means is that foreigners have accumulated more and more of our assets, mainly US Treasuries, than we have accumulated of theirs. Well, again, when your second largest debt holder is the UK, which runs a massive twin deficit, again, massive for a country that is not the reserve currency issuer, that is a tenuous situation for you as the US, because again, to cover that twin deficit, if stresses get acute enough, they're going to sell what they can, not what they want to. And so this is why, for example, British yields heading higher could theoretically push US yields higher, is because, again, they have accumulated huge amounts of savings. And the same is true, by the way, for Japan, just slightly in a different way, which is Japanese investors, by running a current account surplus for many decades, have accumulated trillions in terms of kind of national savings. Well, those savings are in things like US Treasuries. So there is a yield at which Japanese investors go, you know what? I've been in the dollar. I've been in US Treasuries, interest-bearing dollars. I've been in that for a long time, but, the dollar's weakened 11%. And, finally, we're getting rates in my own country, in Japan, that are somewhat attractive. For the longest time, they were basically under 1% or close to 0%. Now, finally, they're offering a decent yield. I'm going to sell my treasuries, pushing yields higher, bond value down in the US, pushing US yields higher, and then sell the dollar to buy the yen to then buy the JGB. So what you would see is US rates move higher. You would see the dollar yen weaken. The dollar would weaken relative to the yen, or the yen would strengthen. And then eventually you will see a top in rates. No one really knows what rate is going to be attractive to get that foreign capital, that Japanese capital, to go back home. But there is a rate. And as this is why Scott Bessent recently called on the Bank of Japan to raise rates, is because this could have massive consequences for the U.S. Treasury market and start to cause a significant Treasury market dysfunction. Now, I did want to point out there is something called the MOVE Index, and this is basically the VIX for the bond market. Fentro, who's in the Discord, he pointed this out. I watch this on a daily basis, but as we can see, has not been indicating that much stress. This is going to be, I think, more important to watch as bond markets around the world are kind of melting down. Watch the MOVE Index because this will tell you, this is basically the VIX for the US Treasury market. And around 125, 130, that is when the stress in the bond market, the expected volatility in the bond market, 125, 130 is kind of the danger level. So we are well below that. This is only updated on a daily basis. We'll get an update at the end of the day. But if you're curious for kind of one area to watch in terms of US specific bond market dysfunction, I would say the MOVE Index is a good one. So anyways, hopefully that was helpful. A lot going on. Again, S&P, NASDAQ, Mag 7, NVIDIA, right? US stocks are down heavy. The dollar is up about 0.5%, which is good, but it's not nearly as positive as you would expect, given how acute the strains are around the world in, say, France and the UK. You would expect to see the dollar up more. Gold is absolutely ripping, up 2% on gold. Again, what do you want to own when sovereign debt is no longer viable, when you can't rely on sovereign debt to pay you an inflation-adjusted real positive return? you want things like gold and to some degree Bitcoin. I mean, Bitcoin is up 2% today, as is gold. So maybe we're starting to see the kind of neutral reserve asset, the scarce asset, of gold and Bitcoin. Maybe we're starting to see that trend or that theme really start to take off. So, anyways, hopefully that was helpful, and I will catch you in the next one.